What's driving the rise of fixed income ETFs?
Hi, I'm Rebecca Venter. Today I'm discussing the major shift toward bond ETFs, including active strategies. I'm also digging into the factors advisors should consider when choosing bond ETFs and what makes Vanguard such a strong provider in this space. ETFs have been popular for investing in the stock market for some time, but are increasingly the preferred vehicle for bond investors too. Over the last 5 years, more than 70% of the inflows into fixed income have been into ETFs. Now, this trend is not a surprise, as ETFs offer many benefits: ease of trading, transparency of holdings and characteristics every day, the potential for tax efficiency, among others. The most recent trend we've seen in the ETF space has been the rise of active ETFs. Nearly 3,000 ETFs have been launched over the last 5 years, and of these, almost 3/4 are actively managed. The establishment of the SEC ETF rule in 2019 played a key role in opening the floodgates to more ETFs, especially active ETFs, as it gave clarity and efficiency on the process to launch and manage ETFs, as well as lowered the cost to do so. Vanguard has a long history in offering ETFs. We're the second largest ETF manager overall, and we offer the world's largest bond ETF, the Vanguard Total Bond Market ETF, ticker BND. But we continue to strive to meet investors' preferences and needs by building out our ETF lineup. And this year, bonds have been at the forefront of that effort. By year-end, we will have launched 11 new bond ETFs across both active and passive strategies. There are a number of factors to consider when choosing a bond ETF, but let's talk about a couple of the key decisions. The first place to always start is just to determine the exposure you need for your clients' portfolios. If capital preservation is your goal, you can consider shorter duration, higher quality ETFs. To diversify a large equity position, that may mean looking into intermediate to longer duration, but still high quality ETFs. Or, as an example, if income is a priority, explore short to intermediate duration ETFs that may have a slightly higher credit risk for potentially higher returns. You can evaluate the talent behind the ETF and assess whether you trust the team that's actually managing the ETF day to day. For active managers, you can consider if they have the talented individuals, the resources, including tools and technology, as well as a strategy to outperform the market consistently. For index managers, you can evaluate whether they have the capabilities to closely track the benchmark. It's also always important to just understand the ETF's design. You can confirm that the ETF's exposures align with your expectations and ensure that the risk and potential rewards are appropriate for your portfolio's objectives. For active ETFs, check that the design is transparent, consistent, and won't leave you with any surprises when looking under the hood into the portfolio's holdings. And finally, look for low cost. As Vanguard's founder Jack Bogle famously said, "In investing, you get what you don't pay for. With lower costs, you keep more of your potential return." And for active ETFs, low costs can give an active team like Vanguard's more flexibility and breathing room to be methodical in their approach to risk-taking. We're excited about the trend toward active bond ETFs because it brings together two of Vanguard's strongest capabilities where we have a significant historical footprint. First is active management in bonds. Our in-house team has been managing fixed income actively since the late 1970s, and we've continued to invest in and grow our capabilities there. The second is in ETF management. Our team has been managing index bond ETFs since 2007. Let's break down, though, why this experience in ETFs is important, especially for bond ETFs. So in managing index ETFs in the equity space, such as the Vanguard S&P 500 ETF, ticker VOO, market makers who provide liquidity in the ETF market can easily create new shares of VOO by delivering the exact basket of S&P 500 securities to align with the index. And this is the case for most equity index ETFs. Managing fixed income ETFs, on the other hand, requires a different approach given the complexity of the market. For much of the bond market, trading is decentralized, involves more negotiating or over-the-counter transactions, and the market just generally has lower transparency. The bond market is also very deep and wide, with multitudes of issuers, with different bonds outstanding, with different maturities, covenants, etc. Given this, creating new bond ETF shares requires customization and negotiation. Since a bond index can't be perfectly replicated, to create a new share of an ETF like BND, market makers submit a sample of bonds called a custom basket to Vanguard, and our fixed income team analyzes it to determine whether it needs certain adjustments. Now, efficiency is key in this process. Vanguard's long history as a bond ETF manager and our familiarity with customized creation and redemption of ETF shares, these allow us to operate with ease and precision with market makers. And that, in turn, makes it easier for market makers to provide liquidity and keep trading costs low for Vanguard investors. In a world where ETFs continue to accelerate, both in passive and now in active, Vanguard has decades of experience and established processes to deliver for our clients. Be sure to like this video and subscribe to this channel for more insights from Vanguard's thought leaders.